Hello everyone, welcome back to my channel. In this video I am going to talk about price change and the effect of price change on our sales quantity, on our revenue. And regarding price change, we have two terms that come in relation with that. One is the price investment and the other one is the price elasticity, about which I already talked in a previous video. Price elasticity of demand, how it is calculated. It is the relationship between price change and quantity change, and you will get a number. If the number is negative, that means you lower your price 1%, then how much your quantity most likely will go up, your sales quantity. If you are more interested or haven't watched that video yet, then please navigate to that video and get your deep dive there. So in this case I'm talking about also the same product, apple, broccoli, potato, walnut, beans, that has an average price for the last 6 months. For example, apple $1.26. The sales quantity, the total sales quantity in the last 6 months was 98,074,000 kilograms. This looks nice, but here I can show you a trick how to format the cell that it shows kilogram. You write kg. And that's it. Price elasticity is calculated from historical data. So in the other tab I recorded price changes and quantity changes over the 6 months period, and I get, for example, for apple average of minus 2.25. That means when the apple price is decreasing 1%, the most likely, based on historical data, my sales quantity will go up 2.25%. The revenue is shown here because we have a price and a quantity. Price multiplied, I press F2, then I can see the formula behind in the cell. C5 multiplied with D5, that is $123,749,000. Why do I show the revenue? Because we want to have a price change, but it is a little bit already going into the direction of pricing strategy that I didn't list in the above header. Pricing strategy, we reduce price. Why? Because it's not a necessity to do it, but in a B2C environment it is most likely happening quite frequently, and we also want to measure the effect of that, or what we want to achieve with that. So the first case can be that competition lowered prices to attract more customers, and we also want to follow them because we follow them. We don't want to lose our customers. Or we want to increase sales. Simply increase sales, not looking at cost, margin, or competition. We want to win market share. We want to increase sales, or we are aware that there is a new customer base that is available. These are two very likely scenarios in a B2C environment. In a B2B environment where you are selling to huge businesses, this is also a likely scenario, but not very likely to happen more than 1 to 4 times a year, or you can renegotiate with a customer but that is a different environment. Meanwhile, in the B2C environment, it can happen quite frequently. The price change can happen weekly. Imagine this is a grocery supermarket. We are looking at a very narrow range of products, 6 products. For these 6 products, apple, broccoli, the price can change, or you can have discounts. Then you want to see the effect of the discount, and this is one side of the coin, because the price change will assume a quantity change as well, and you need to see in B2C if you are able to buy that much products. You will have enough suppliers to supply to you, and of course suppliers, a third scenario, that your supplier reduced price. Although in today's economic environment this is a very unlikely scenario. So let's see how much will the quantity change. As I said, if the price change 1%, price change decrease 1%, then your price will go up 2.25 multiplied with 2.25. so the price change, the quantity change will be E5 multiplied with this one, 4.5%. You can pull down the formula, and here below you see the average. That is the average quantity increase. Just like here, the average price decrease, average price decrease is -3%, and this one is 8%. So almost the elasticity is nearing 3. Price investment. What is price investment? This will be our investment. We will see how much money we sacrifice given the fact that our quantity doesn't change, which is very unrealistic, but in the worst case scenario we will lose this much money. That means the price change multiplied with the revenue. So 2%, because we assume that the quantity is the same and revenue is made up of quantity times price. Our price reduced 2%, so this sum or this multiplied value will also reduce 2%. So our invest will be $84 million, assuming our quantity doesn't change, but this is not realistic in the real world. Expected sales quantity. This is the old sales quantity times our new assumed increase. So I can do the format painter, and here this is also kg. Then we will calculate the new price, because we will have a new price. So the new expected revenue will be made up of new price and the new or expected sales quantity. New price is this one multiplied with 1 minus 1 plus, because this is minus plus minus will be minus the price change. So it's a 2% reduction. That means our price will be 98% of the old price, which is 124. So the new average price is 4.67. The original price was 4.82. So what is our expected revenue? We have two new variables that will make this up. the expected sales quantity times the new price. So what is our new revenue? 2,829 million, and our old 2,759. Is it an increase? Yes, of course. How much can it increase? So quantities increased 8%, prices decreased 3%, and 2,759, 2,829. In this case, when you go back to the percentage calculation, 270 is 10%. 2,000. So that is more. Let's see. Absolute difference equals this one minus the old revenue. Oops. Reverse. Pull it down. 70 million more equals. Normally the new value minus the old value divided by the old value, but I already calculated the difference, so this one divided with the old value. So this is 4.65%. My guess would have been 5%, but yeah, I'm not very accurate with these huge numbers. So we can see that the absolute difference is 70 million and our invest is 84 million. That would mean, strictly speaking, we a plus. We lost 14 million, but this is not an investment in a classical meaning. We can see that we managed to increase our sales. Now here in the Excel table, if it works in reality, you always need to wait eagerly whether the customers make your calculation the real life. So this strictly speaking wouldn't speak against the investment, but in the worst case scenario, when the customers don't react to your price change, you could lose money to a certain extent. Well, yeah, that was it for today. Thank you very much for your attention. Have a nice day.